Cars don't kill businesses, assumptions do. Income tax taxes profit, FBT taxes perks. If you've ever said it's for business, so it's deductible, this video might save you a lot of money, because that sentence has triggered more unexpected tax bills than almost anything else I see, and it usually involves a car. I've never seen a business collapse because it bought a car, but I have seen businesses quietly lose tens of thousands because they didn't understand the tax attached to it. Cars don't kill businesses, assumptions do. So let's unpack this a little bit. The issue isn't income tax, it's FBT or Fringe Benefits Tax. And here's the key distinction. Income tax taxes profit, FBT taxes perks. FBT isn't triggered because something is deductible. It's triggered because a benefit has been provided to an employee. And for FBT purposes, the term employee is broad. It includes company directors, trust beneficiaries working in the business, office holders, and current, past, and even future employees. If a car is provided and it's available for private use, there's a benefit. Notice the wording here, available, not abused, not predominantly private, available. If it's garaged at your home overnight, it's available, and that's enough. Most business owners start with the wrong question. They ask, is it deductible? The better question is this a benefit? Because tax deductibility comes far off down the line. The real misunderstanding, they think it's a once-off decision. It's not. GST is refunded once. FBT is paid every single year. Every year the benefit exists, and that's the part no one thinks about when they're standing in a car yard. I have a micro client, a carpet cleaning business. The owner rang me super excited. She'd bought a new car. She was so proud. She put it in the company name to claim the GST. It was the 30th of March. She picked it up on the 31st of March, the last day of the FBT year. Because of the timing, there was no logbook, no chance to do any modelling. She was thrilled about the $3,181 GST refund. And then I had to give her the news she absolutely didn't expect. Because she collected it on the 31st of March and there was no logbook, the statutory method applied to the FBT. The first year FBT was tiny, it was about $20 because it was apportioned, and she thought she'd got away with it. But from the following year onwards, $4,456, and let's not forget the 7 cents every year. She claimed $3,000 back, she committed to $4,500 annually. Whilst she thought she'd made a tax-savvy decision, she'd actually created an annual employer tax she didn't even know existed. And here's the bit that really bit. I'm the one who felt guilty, frustrated, annoyed, because it was just so preventable. When I asked if she could delay collecting the car, she was already leaving the car yard. She didn't reply to my emails for a week, and I think she was probably embarrassed, definitely shocked, and possibly even a little bit annoyed. Cars don't kill businesses, surprises do. Cars are emotional purchases. They feel like success, progress, reward. When emotion enters decision, logic becomes very selective. When we want something, we look for confirmation, not correction. So we focus on things like the GST refund, the deduction, the resale value, and we ignore the recurring obligation, the employer tax, and the compliance exposure. Who are the most at-risk owners? The confident ones. The ones who say, we know what we're doing. The cautious ones ring us first. The confident ones sign first. Speed is expensive when tax is involved, and there's another layer. FBT is paid by the employer, not the employee. So when you salary package a car, or try to be generous, or try to wow some new employee that you're bringing on board, you totally forget generosity without modelling is just plain old expensive. Australia runs on a self-assessment regime. You tell the ATO what's happening and they accept it unless they decide to check. And here's the really uncomfortable truth. You are guilty until you prove your innocence, not the other way around. If the ATO believes the tax recoverable exceeds the cost of pursuing you, they'll pursue you. If they find one issue, they will look to expand the scope. They will compare your odometer readings, they'll cross-check GST, they'll model patterns. Just because it's a 1-ton ute doesn't mean it's automatically exempt. It must not be used privately except for very incidental trips, things like going to the tip. Driving it home and doing school runs is not considered to be incidental. If you don't measure it, the tax office will assume it, and that's where it gets dangerous. Where does this really hurt? The first FBT return, because no one was expecting it. It lands, it's due, and after that, an instalment amount is included on your BAS for you to pay together with your GST. So yes, FBT is deductible, but that doesn't help your cash position. Deductible doesn't mean affordable. It constricts cash flow, often right before end of financial year, right when you want to invest in equipment or a super top-up payment, right when you want to move forwards. And now you're paying tax on something which is, to all intents and purposes, a perk. Before buying a vehicle, you need to ask 3 questions. Number 1, does it actually need to sit inside the business? Sometimes it's cleaner, cheaper, and more flexible to own it personally and claim business use. Other times, it genuinely makes sense to have it in the company, but that decision should be made with numbers and not emotion. The structure determines the tax. Quote number 2, if it's in the business, how will it be used? This is where a lot of people fall over. There are 2 broad ways the tax can be calculated. One assumes a fixed percentage of private use regardless of reality. The other requires evidence like a logbook to show how the car is actually used. If you don't prepare properly, you default to the assumption method, and those assumptions are rarely favourable. So prepare a logbook, understand how the vehicle is genuinely being used. And number 3, what is the lifetime cost, not just the GST refund? So this is where a lot of people get blindsided. They see, oh great, I get the GST back, and they forget there may be an annual employer tax attached to this. And that tax is based on the value of the vehicle, not what you think the private use is worth. It's not minor, and it repeats every single year. GST is a once-off sugar hit. FBT is a recurring bill. When we model it properly, sometimes the outcome surprises people. Sometimes FBT is manageable. Sometimes it wipes out the benefit entirely, but we know before you sign, and that's the difference. If you've already bought the car, well, step 1, don't panic. Step 2, get clarity on how it's actually being used. Step 3, run the numbers properly and adjust your behaviour if you need to, because the real problem isn't the FBT, it's not knowing it was coming. So we have our carpet cleaner, $3,181 GST refund, $4,456 per year in FBT. She made an emotional decision. There was no chance to do any modelling. She didn't even think about any kind of ongoing obligation, and it created a cash flow squeeze. The whole thing was avoidable. We have a physiotherapist client. She found a deal on a new car, $46,800 purchase price, and she rang us first. We ran the numbers. If it was bought in the business, there would be a GST refund of $4,254 and FBT of around about $9,151 per year. So instead, she bought it personally. Kept a logbook, which showed 88.42% business use. For the 2025 financial year alone, there was an $8,695 deduction in her personal return. No FBT, no ongoing instalments, and no surprises. Only relief, confidence, and clarity. Same car, completely different outcome. The difference wasn't intelligence, it was timing. She asked us first. By all means, buy the car, upgrade it, enjoy it, reward yourself. But think twice before buying it in the business, because cars don't kill businesses, surprises do. And FBT is only a surprise if you didn't ask the question.